Tonight's webinar will be on market outlook for Q2 2021. So it'll be hosted together by Nick Walker and also Ritesh. So Nick is actually heading our investment products while Ritesh heads our investment advisory. So I think together they're going to provide a very good webinar for you guys who are wondering what's going to happen ahead. All right, over to you guys.
Great, thanks, Melvin. And hi, everyone. Thanks for joining today. So today we're going to cover our market outlook for the coming quarter, as Melvin mentioned. I guess before we get into the content, we just wanted to highlight a few things that are top of mind for us right now. Obviously, COVID remains top of mind, the vaccine rollout, as well as resurgence in certain emerging market economies. We continue to see strong fiscal and monetary tailwinds that are providing a very, very solid backdrop for the economic recovery. This is, though, leading to some increasing concern around inflation. So we'll definitely cover that today. And really what this comes down to is our core recommendation for today, which is to stay invested and diversify. So quick agenda for how we'd like to run through the content this evening. Ritesh is going to provide an update on markets over the last quarter and you know, the themes and trends we've seen there. I'm going to talk a little bit about the economy and give an update on how things are looking, particularly in the US. And then I'll hand back to Ritesh, who's going to talk a bit about our outlook for the next quarter and the rest of the year in particular, some of the risks we see on the horizon, as well as our investment strategy. And then I'm going to provide a bit of an overview of SAIS for those who are newer to us, as well as an update on the performance of our portfolios. And then we'll obviously have time for Q&A. And if you do have any questions along the way, please feel free to enter them into the text box. So with that, we'll start with the market snapshot, and I'll hand it over to Ritesh.
Hey, thanks, Nick, for the introductions and setting up the agenda. So, hi everyone. This is our Q2 market outlook webinar for this year. I thought it'll be great for us to start with having a quick snapshot of what's been happening in the markets as well as recent news. So, the top of mind in terms of markets right now is the earnings. So, a lot of S&P 500 companies are announcing earnings over the last few weeks, and I think that has had an impact in terms of how the perception is going forward as well. So if you look at S&P 500, as Nick was mentioning, post-COVID recovery as well as vaccine news rollouts that came in, say, in November, December of last year, we saw a continued rise in the global equity markets going up to the first quarter of this year, up till April 2021 as well. And then, only last few days, we have been seeing some consolidation in terms of the markets giving up some returns. But important to highlight that out of the 500 S&P companies, more than 300 have had earnings beat, and 87% of them have topped analyst expectations, as per the estimates. One of the highlights of the earnings seasons has been the big tech, earnings, and they continue to do, very good. They print very good results over quarters, and that is something that has been, something for us to note about. But I think the markets are increasingly looking at forward guidance for these companies, given that most of these are high growth areas, and essentially the future growth prospects have an important role. And given that there are some inflationary concerns in the market as well, there are those things panning out that even though the earnings have had a beat, that's not necessarily resulted in a sustained rally over these companies in the near last couple of weeks. So if you look at a little bit broader into the global equity markets, and if you go on to the next slide, yes. So post the COVID, vaccine news and the rollouts, essentially you can see from November onwards, most of the global equity markets rallied. And only in February, March is when you see that inflationary concerns and other high valuations also dominated consolidation of results and returns in the later half of the first quarter. So markets have been consolidating over concerns of high valuation and inflation. Sentiment is looking like close to be overbought, but we believe there is, still it is still not at dangerous levels of euphoria and things like that. Overall, across the board, there has been a sustained rally across the world as well. Only China is where you're seeing that there has been some pressure and negative returns on a year-to-date basis per se. But broadly, there is a sustained increase in returns across the board. So if you go on to the next slide, yeah. So I think this is another thing that has happened as the vaccine announcements have happened, that the rally has actually broadened, and the first half of COVID recovery was dominated by the growth sectors. Now the rally has broadened to other sectors. Sectors such as hotels, resorts, cruise lines, retail, like the REIT sectors, airlines, energy, more of the cyclicals as well. Again, potentially if the interest rates and long-term yields rise, those are things that dominate these results as well. Right? Nick?
Yes.
All right. Sorry, I'm not sure if I'm audible. Are you guys able to hear me?
I think you're fading in and out, actually.
All right. Let me try to, yeah. Okay. Let's also look at the asset class returns across different assets. What you will see is a strong reversal in terms of different asset classes. So whether you look at commodities, REITs, infrastructure, these, as the vaccine rollouts have happened and economies open up, you see that these sectors have started being the leaders of the pack in terms of return. And US equities in general, have continued to drive returns for 2021. We've also caps have had more pronounced outperformance against the growth sectors. And again, this is something from the high growth, high valuations, dominating the growth sectors to the value sectors where the potential, price and valuations are much more palatable. So again, if you look at the data, if you see the value, the large cap, and it is across the board, whether you look at large cap, mid cap, and small cap, the value sectors have had at least like 5 to 10% outperformance against the growth. If you go on to the next slide, there have been some concerns about treasury yields, going high up to like 2 and breaking the 2% barrier. So mostly it is dominated by the fact that more stimulus measures have been taken, and with the rollout of vaccinations, there have been concerns that inflation expectations can be much, much higher than what is being anticipated. But what we believe is, if you look at what the treasury yield is dominated by, it is basically composed of two components. One is the expected inflation, and the second one is the real yield. On this graph, if you look on the red line, that is basically your 10-year treasury yields. And again, if you just concentrate on 2020 and 2021, the yellow bar, what you will observe is there have been a slow movement up in the 10-year treasury rate over the course of later half of 2020 and earlier this year. Only recently what you've seen is the 10-year treasuries have now consolidated and have stabilized. And mainly, I think part of the reason is that the Fed has come in and spoken, saying that there is very low likelihood of them increasing interest rates in the near term, and they have said that essentially we don't anticipate the interest rates to go up or need to be moved before 2023. So some of the inflationary concerns are a little bit unwarranted, in my opinion, as well. And there is still slack in the US economy, and some of the services sectors will take time for them to come back online. So what this means is essentially from a near to medium term outlook, the long-term treasury bond yields seem to have stabilized, and we don't believe they will break out beyond 2% in the near term. Similarly, I think the inflation concerns have also impacted the commodities market. More specifically, certain commodity prices have climbed to multi-year highs. So if you look at copper, lumber, these are again indicators of economic activity picking up. As more and more economies are opening up, you see that these are the drivers to growth, and essentially because of inelastic short-term supply as well as more bullish forecasts of recovering demand has sort of provided a macro tailwind into some of these specific commodity sectors. More specifically, if you look at the oil sector, the oil futures have also started participating in this rally in the last few weeks, and what you see is WTI and Brent now steadily moving beyond the $60 a barrel mark over the last few weeks as well. So again, some of these things are important to note as we think through, from a future standpoint, if this is the current state of the market, what does it entail going forward? Like, as we were pointing out earlier, inflation is a valid concern. Vaccine rollouts have happened. There is a second wave, third wave of coronavirus happening. So that is also something of a risk element to the global recovery going forward. So I guess what we can do is take a peek into some of these elements in terms of where they are and how they can shape the path to economic recovery going forward. So Nick, do you want to take this?
Sure. Thanks, Ritesh. So as Ritesh mentioned, COVID still, is one of the key dominant global themes for us in terms of understanding where we're at from an economic recovery perspective. So let's take a look first at the US. So on this slide, we're showing on the left-hand side the number of daily, the 7-day average, rolling average cases of COVID in the US. And you can see, obviously, that has trended down significantly. So since the highs in November, December last year, the US is now seeing average daily case numbers of less than 50,000, which is a significant drop from the highs of 250,000 plus a few months back. And this is really as a result of the vaccination program. So on the right-hand side, you can see the vaccination program has picked up in a major way in the US. This chart is showing the number of people that have received at least one dose of the vaccine, and it's now at about 45% in the US. So we're sort of approaching those areas where you also consider the number of people that have been infected in the past, where the US is starting to get to herd immunity. Now, unfortunately, this doesn't represent the COVID trend globally, as you can see here in the chart with global daily cases, which has trended up significantly in the last couple of months. And so where are these new cases coming from? Well, we've all probably been following the news, but it's predominantly in select emerging markets, notably South America, India, and some other smaller markets like Nepal and Mongolia, as well as some other markets in Southeast Asia, where we've seen a significant increase in cases, partly due to variants of the virus that have been, spreading around the world and are much more contagious than some of the earlier variants, and also because these less wealthy countries have had more trouble with the vaccine rollout. So you can see on the following slide that while many of the developed markets that had significant COVID problems last year, like the UK, the US, and parts of Europe, these are the countries that have been able to ensure significant vaccine supply and rollout to their populations, and so are no longer seeing the number of caseloads that you were seeing last year. That's a stark comparison to some of the emerging markets like Brazil, India, and we also show here overall rates for Asia and Africa, where the vaccination rates are significantly lower. So really, COVID remains a factor. It particularly remains a factor as we think about emerging markets and think about the less developed parts of the global economy. But obviously, that does have an impact globally on certain sectors as well as we look forward. Moving on to another key theme in terms of the economy, and that's around fiscal support and fiscal policy. And I think the key takeaway from this slide is that the amount of fiscal support that has been rolled out in response to COVID, particularly in developed economies, has been absolutely unprecedented. The chart in the top left-hand corner compares the economic shock from COVID in yellow versus the global financial crisis in orange. And this chart is for the US, but you can see that the actual shock to the economy from the GFC was 3 or 4 times larger than the overall shock to the economy from COVID. And yet, when you look at the right-hand portion of that chart, you can see that the fiscal response has been multiple times larger. The amount of fiscal stimulus in the US has been over 20% of US GDP, versus in the global financial crisis where it was less than 5%. So a huge amount of fiscal support in the US, but also, as you can see in the bottom left-hand chart, also in other emerging, in other developed economies as well. So in Japan, more than 15% of GDP, in Australia and France, Canada. And so it really is clear that a lot of this fiscal stimulus has been concentrated in developed markets. So yet another reason why we're seeing developed markets lead in terms of economic recovery as well. Another interesting feature of the fiscal packages this time around has been the amount of direct payments going to individuals, particularly in the US. And just as an example of that, on the right-hand side, we can see the breakdown of spending in the most recent stimulus package that was passed in March in the US, which is the American Rescue Plan Act, so basically the Biden fiscal rescue plan. And you can see of that, almost half of it is in the form of direct payments to individuals, either through unemployment programs or through stimulus checks or tax credits. So, a huge amount of transfer payments directly to individuals from these stimulus packages. Moving to the next slide, and the other, very strong tailwind for the economic recovery is from monetary policy. So we all know the Fed reacted very, very quickly last March to reduce interest rates back to zero. At the same time, they have dramatically expanded the size of their balance sheet, which is what we're showing here on this slide. So on the right-hand side of the chart, you can see in that yellow portion from about March last year, you can see huge increase in basically the amount of assets on the Fed's balance sheet, which is a representation of the amount of stimulus that the Fed has injected into the economy. As Ritesh mentioned, we expect that this support is going to continue. The Fed themselves have said that they're likely to keep rates, at or close to zero for at least another year to 18 months. We don't see any reason why it won't be longer than that, as long as the key measures that they look at, which are inflation and employment, remain in check. So on that note, let's look quickly at employment. So this is a chart showing long-term unemployment and as well as wage growth in the US. The 50-year average unemployment rate, you can see in the box up the top, is 6.3%. Last year, unemployment in the US did spike to a high of almost 15%, but you can see, really a very dramatic decrease in the unemployment rate back to that 50-year average of about 6.2%. As of February, and that number has been pretty stable in the last couple of employment reports as well. So while it's close to the 50-year average, it's still significantly above where we were at pre-COVID, which was below 3% unemployment in the US, and so there is still considerable slack in the labor market in the US. This is something that the Fed's very focused on. They've said themselves that they would like to get the unemployment rate back further down. And this is one key reason why we expect that they will keep monetary policy very easy for the foreseeable future. One impact of both the fiscal packages as well as the rebound in employment has been a huge rebound in consumption. And as many viewers may know, consumption is the biggest part of the US economy. It's about 70% of US GDP. And so it's, it's very encouraging to see those huge spike back to trend growth in personal consumption expenditures in the US. Again, driven largely by the rebound in employment, as well as that direct to citizen stimulus checks. So with that, I'll pause and move back to Ritesh to cover off how we see the markets and the economy panning out on a look-forward basis. Ritesh, I think you're on mute.
Sorry. Hi, thanks, Nick. So if you go on to the next slide, essentially, these are economic forecasts from IMF. These are early 2021 forecasts. And as you can see, the global economy went through unprecedented, sort of downturn in 2020. But there is a huge uplift in 2020 across the board, across the world, in terms of expectations of GDP growth. And to that extent, the US GDP is expected to grow at 5.1% for 2021. We have the Q1 numbers for US GDP, which expanded by 6.4%. So much better than the forecast numbers that we have here. And the boost in GDP really came across a variety of spectrum and areas as well, including consumption, whether it is investment as well as government spending. As Nick was mentioning, consumer spending account for close to 70% of the US economy. And this was accelerated by around 10.7% in the quarter compared to like a 2.3% increase in the previous period. Similarly, expenditures were also saw a good growth, and they were mostly on the goods side, which increased by close to 24%. But not just that, not just consumer spending, but and expenditures on goods, but also services, which have been a little bit of a laggard, have been the missing link for recovery in the overall setup, also grew by 4.6%. So hopefully, as vaccination drives continue, we expect the services segments could lead the next phase of growth across the board for US and then across the globe as well. Now, if you look at on the next chart, we also see that this has increased inflation expectations because if there is so much spending happening, if the services sectors are opening up, there has been concerns of rise in nominal yields in this year due to higher average inflation over the next sort of 10 years. This expectation for inflation has actually increased, like if you look at this chart, from close to 1.6% early, in November 2020, and post the announcement of successful vaccinations, it has increased to 2.3%. Now, again, having said that, if you look at the next chart, from a Fed standpoint, overall, the GDP numbers have started their recovery process, but they have still not crossed the previous peaks. And what that means is, essentially, if you look at the two core metrics that Fed looks at while they decide whether to increase interest rates or not, which is basically your inflation numbers and unemployment numbers. Unemployment numbers have come down quite significantly to around 6% now, but they're still well below or well above the levels that were there pre-COVID, which was around 3.5 to 4%. As well as in general, the number in absolute terms, the number of people employed, there are still close to 8.4 million fewer, jobs than prior to the pandemic. So, while things have recovered and they look, rosy in the near future, there is still spare capacity in the US economy, and which means that broad-based inflation pressures are sort of unlikely until 2023, in line with what the Fed expects. And essentially what we believe is that unless inflation breaks above 2.5%, it will be very hard for the Fed to increase interest rates in the near future. If we move on to the next slide, this also brings us to the question of the current valuations of the US equity markets. If you look at this chart, it shows you the forward PE ratio of the S&P 500 index. And what you will realize is the current levels are more than one standard deviation above the historical average at which the US equities trade. And again, while this does look, stretched, I mean, we have to put this in context that where we are in the market cycle, the low interest rate environment, all of these are the driving factors. The low bond yields, if you're looking to deploy your money and you want, some risk premium attached to it in terms of returns, where will you park your money? So, I mean, with the low bond yields and other asset classes still challenged, I think the US equities, even though they are stretched, they should, they sort of support and justify the valuations at this point of time, given the enormous amount of stimulus programs that have been running, per se. Also, in general, the global economy in the second half of the year should see, more outperformance, like, from non-US equities as well. So while the US equities have continued to see, good returns coming into this year, I think if you move forward, the return drivers might be, beyond the US equities, where if you look at from a valuation standpoint, the valuations look, on a relative basis, much, much more palatable compared to where the US equity markets are trading right now. If you look onto the next slide, within the US market and in general, what you'll also observe is, and this is like, very relevant if you just look at the market performance data over the last few weeks. If you compare, say, NASDAQ on one side and Dow Jones on the other side, NASDAQ has been a laggard, and we're seeing the Dow Jones been outperforming NASDAQ on a day-to-day and week-to-week basis on a consistent manner over the last month or so. And just coming into the whole year per se as well. So the growth outperformance, which was sort of dominated through the last decade, seems to be waning a bit. And it looks like, the investors are looking to rotate from, highly valued growth sectors to, the low valuations that the value sectors command. Also, in general, if there are inflation concerns, it usually translates into long-term interest rates being higher. And what that means is, all of these growth companies are considered long duration in nature because their growth is supposed to happen over a longer time period. And if your interest rates are rising, what that means is when you discount those future growth to present value, the valuation decreases for these growth stocks. So that's been a driving factor of why we are seeing some sort of trend reversal and factor rotation out of growth stocks more into value stocks. And this I can, again, if you look at the next slide, it is a little bit more pronounced here, where some of the more speculative space, a little bit more on the disruptive innovation side. The ARK ETFs and all have been very, very popular coming into 2020. They've had like spectacular returns of 100+% returns over 2020. Coming into 2021, we are seeing that these sectors, which again had such high valuations, are showing significant underperformance compared to broad-based indices such as S&P 500. So in general, what we believe is the value sector does look cheap compared to the growth factor. Furthermore, the US stimulus, package, as well as reopening from the lockdowns, should really boost earnings growth for the cyclical sectors such as materials, industries, that also have a higher weight in the values, index per se. So, if you look at it from a going forward standpoint, we believe that this trend might continue, and the next phase of value outperformance also might have greater leadership, not just from the US market, but also non-US per se. Having said that, I don't think, we should totally ignore the technology and the growth sectors altogether, I think our view will be to remain invested into quality tech names because as I shared earlier, when you look at the earnings, all the technology names have had big beats coming into this quarter, and they continue to dominate their markets. So these technology companies, might have a little bit higher valuation attached to them, but they have become fairly entrenched into our daily lives. What that means is, from a more long-term basis and a long-term investment horizon perspective, you should still have some of those elements in your portfolio. Let's look at the next slide. I think this is also important to just highlight that, especially over the last, couple of months, we have seen increased levels of speculation, not just into the equity markets, but broadly across the board. And when you see things like cryptocurrencies, and some of the cryptocurrencies which also, do not even have a basis to it, like, if I talk about, like, say, Dogecoin, they've had a crazy amount of rally without much justification as to why that has happened. And that has really led to a lot of speculation because there is a lot of FOMO in the market where people don't want to get missed out. And they enter into these speculative trades where they don't particularly understand the implications of what they are investing into. So, this chart basically encapsulates that element that the debt, the margin debt, basically the borrowing that you see in the market is at record highs. And what that means is, the measures of speculation do look, pretty high at this point of time. If we look at the next slide, does that mean, are we in a bubble? While, all the data points that we have shared earlier point to stretched valuations as well as, inflationary concerns, which potentially might have, near-term impact in terms of consolidated returns going forward. I guess, like, overall, if you look at this chart, I think this is more of an inflow kind of a chart in terms of showing to you that if you just look at the blue area, the shaded area, it talks to you about the net inflows into the equity markets since the financial crisis. And what you'll observe is most of the money that has entered into the financial markets over the last couple of years has actually ended up being into the fixed income or money market side. What that means is there is still a lot of money sitting on the sidelines. So we should not just discount that fact that, like, money is still actually sitting there on the sidelines and ready to be deployed. So, and, on top of that, if you think about, the enormous amount of support from a fiscal monetary standpoint across economies that is, there, we can still see the global equity markets to remain supported overall. I think what will be key test for the US equity markets, would be around, the rising bond yields and inflation numbers. So again, if the inflation numbers remain at below 2.5% per se, I think, you won't see runaway inflation and, the need for the Fed to take any drastic measures. And what that would mean is, like, in the near term, if broad level, all these support measures still exist, we can expect the equity markets to remain supported as well. So now I think that brings us to the important question that, yes, I mean, there are certain concerns. At the same time, there is still a lot of support in the global economy from the central banks as well as the governments. So there is a bit of a dilemma from an investor standpoint. Should you remain invested? Should you, do something? I think the best answer to that is, not to be overtly concentrated on single names, single, sectors, or, don't get, sort of swayed by speculative, tendencies in the market. So whether it is the cryptocurrencies, whether it is, specific high growth, names that have, like, especially I think with the prevalence of social media and the meme stocks and all of those, a lot of clients and a lot of investors are getting swayed and they're investing into things that they have no idea what they are getting into. So I think the number one thing that every one of us need to make sure is diversify, right? Like, don't put all your eggs in one basket. This is the only free lunch that is available. If you, again, look at this particular chart, what it goes to show you is, the fact that if you have a more diversified portfolio, the kind of variance that you see is much, much lesser. You will have a much more steady return profile. And I think this is very, very important because, it is not just about reaching the end goal. The journey to that end goal is equally important. And, a lot of investors, what I've seen is they lose the battle, in the middle of their journey because, when they invest into something with very high, growth expectations, sometimes they ignore the possibilities of sharp corrections in those particular areas that they're investing into. And they might not, assess their risk appetite in a fair manner. And what that means is when there are corrections of 10, 20, 25%, they panic and they sell out. And usually these are the times where it is basically the worst time for you to liquidate your investments. So it's actually much, much better to build a much stronger foundation to your portfolio by diversifying your investments across asset classes, across geographies, across sectors as well, right? And once you have done that, then you have plenty of room to have a little bit of play money to do things and, express your views in the market as well, but have that foundation built first. If you look at the next slide, at the same time, I think the foundation that we are talking about does not mean that, a 60-40 portfolio is the right choice. In the current environment, again, this is a busy chart, but I think what it tries to show you is that in different inflationary environments, a 60-40 portfolio might not do the best for you. And especially, when we have a strong cycle which delivers preference over equities over bonds, so despite expensive valuations, the equity markets, is where you see the risk premium being, added in a much more fair manner versus the bonds. I guess, if there is inflation, the bonds will equally be challenged because, as interest rates move up, the bond prices will take a hit. And essentially what that means is a 60-40 portfolio might not be the best, solution for you. So do look at your asset allocation and see if, a more pro risk or a pro equity allocation makes more sense for you. And again, I just want to highlight in the bottom section of this chart, if inflation is within a range of, say 1 to 3%, you will observe that, more pro-risk approach still gives you better returns. And even in cases of runaway inflation beyond 3%, the difference between traditional 60-40 portfolio and a more pro-risk portfolio is almost similar. So from that standpoint, a rising inflation still points to a pro-risk asset allocation. You should still be guarded, as I said, diversify your investments. If you're thinking about allocations, think about the rotation that is happening from growth to value. And within the equity sector and within the equity markets, look at beyond the US as well in terms of having a globally diversified portfolio too. On top of that, I think if you go on to the next slide, it is very important to protect your downside because essentially the more you lose, the harder it is for you to recover. And this was again pronounced last year as well when the equity markets did fall by more than 30-35%. And we were just lucky with the enormous amount of stimulus programs that were run that the global economy, had a sharp upturn, as well as the equity markets, sort of led that upsurge as well with more than 50% recovery. But the point really here is if you lose 20%, you need 25% recovery. If you lose 30%, you need 43% recovery. So don't, ignore that fact that, don't go beyond a certain risk appetite if you're not comfortable with it. Protect your downside. It's very, very important. And I think last but not the least, a lot of people do, and I think will have this question that should I book my profit? Should I come out of the market? Is this, and especially I think looking at the last few days, what's been happening in the markets, a lot of investors are getting a little panicky. I think this slide just tells you why it is important. If you've built a strong foundation to your portfolio and it is diversified, remaining invested is actually the best thing to do. And what this chart basically shows you is that, yes, you can take money out of the table right now, but how do you know when you need to get back into the market? I think this is something that a lot of investors missed out in 2020 as well. The market fell 35% from February to March. A lot of investors liquidated their investments, but by the time they could re-enter, the market has already rallied, right? And this chart again tells you that if you miss 40 best days of recovery, then the returns that you might end up with can be significantly lower versus if you remain fully invested. So do look at reallocations, do look at at your portfolio in a much more closer manner. If you're not diversified enough, make sure you focus on diversification. But I don't think timing the market is going to really help you. I think as we have been sort of espousing throughout our journey in SAIF, time in the market is a much more important factor than timing the markets. So just quickly summarizing all the points that we discussed today, essentially, equity bull market has broadened as we have observed. Most of the services sectors and cyclical sectors have started participating in the rally and now are leading the pack and outperforming the traditional, the growth sectors, which had dominated the returns over the last, decade or so. Long-term treasury yields have stabilized after the earlier sell-off. So again, pointing out that inflationary concerns are there, but looks like from a near-term standpoint, those concerns have been, have been a little bit unwarranted, and to that extent, the long-term treasury yields have stabilized a bit as well. On the same side, as the economies are opening up and services sectors and everything is opening up as well, some of the commodities are appearing to break out to multi-year weakness. So this is something for us to take note as well. If you look at from a COVID and the virus segments, the developed markets have had a much better 2021 post the vaccine rollouts because they have easy access to the vaccines versus the outbreaks continue to hurt some of the more emerging markets. Having said all of this, the fiscal and monetary stimulus programs continued to be, continue to be there, and again sets a strong foundation to a continued rebound. Inflation expectations have consistently crept up. They are an area of concern, but we should not be worried until and unless inflation goes beyond 2.5%. And again, last but not the least, as we covered earlier, make sure that you have a diversified portfolio that can protect you from downside pressures. Don't try to time the market and stay invested. So those are, I think, the key messages for us today. I guess I will take a break right now. Nick, do you think we should take some questions before we move on to the next section about SAIF?
Yeah, I think so. Melvin, let's see if there's any questions that have come through.
Okay, so I think we can actually start with this one. The recent inclusion of China, or rather the increased allocation towards China via the 2 new ETFs from our portfolios. So I think this question actually kind of relates back to that. So prices of Chinese stocks have fallen rather dramatically since the start of the year. So do you think that SAIF thinks that Chinese stocks are currently undervalued or fairly valued? And does this affect any of our portfolios which include exposure towards Chinese equities?
Nick, do you want to take this? Since we've recently included these in our portfolios.
Yeah, so, I guess, if you look at valuations of equity markets globally, we certainly do see a significant valuation gap between, the US and particularly emerging markets, and that includes China. There's no doubt that emerging market valuations are much more attractive on a fundamental basis. And as, we showed on the chart that Ritesh covered, Chinese stocks year to date have, after a significant rally late last year, have weakened somewhat this year, particularly around some of the growth and technology-oriented names, and certain idiosyncratic risks in some of those names, due to regulatory changes. But to the point made in the question, our models have indicated to us that it's an attractive time to be adding China. The timing can't be always perfect on changes to portfolio allocation, but we're pretty confident given the strong economic recovery in China, which is really leading the world out of COVID, as well as the attractive valuations and really attractive stories within some of the companies that we own, within China that an overweight and a targeted allocation in that space will pay dividends for the portfolio over the medium term.
Right. And just to add, I think our addition to China is also driven by the fact that the economic contribution of China and, the related economies, if you look at it from that perspective as well, I think it was not justified to have a very, very small allocation to China. I think the current changes that have been done into our portfolios actually just normalize the exposure. It's not like, we are taking a 30-40% kind of exposure to China per se. It's, I think, a more like a 15% overall exposure. So I guess it is just a normalization of exposure to better include a growing economy from a long-term standpoint and the attractive valuations and all of those points as Nick covered as well.
So thank you both for the answer. So I think this one will relate back more to British. This question, does Saif agree with Goldman that the next commodities super cycle has started? If so, how can clients capitalize on this?
Right. So I think in general, I think we are coming off a multi-year weakness in the commodities sector. And I think, that's one of the more primary driving factors why you're seeing such high, growth and breakout growth for some of these commodities. Some of these commodities also, as I shared earlier, suffer from inelastic supply. And as, the labor market picks up and availability of workforce increases, that's where we can see some evening out of, these sectors and these commodities per se. But in general, combine this with inflation and, increasing yields, it does mean that commodities can have a, much more sustained rally going forward as well, right? So I think those are more of the fundamental reasons why I believe the commodities are seeing the rally that they're seeing right now. In terms of how persistent they will be, I think there will be some consolidation once, these supply, gaps are addressed. But in general, given on top of that, inflationary concerns and all can mean that commodities could be a good space for us to, have some exposure in as well.
And for yourself, Nick, do you believe that will increase materials exposure for the portfolio?
Look, in terms of actually, dedicated exposure to commodities, we don't have a product right now that's specifically around commodities, although many of our core and as well as our global IRE portfolios do include an allocation to gold. We do have obviously some commodities exposure to, to companies that operate in that space. But we're always looking at, ways to enhance our product portfolio. So it's certainly one to consider for the future.
Great. So thank you both again. So maybe one last question before we move on. This one will relate back towards the REITs product. So do you think Saif intends to launch or rather reform the product with other REITs from other countries?
That's an interesting question. The REIT product currently is composed of Singapore listed REITs. It does track an SGX, the SGX REIT index. So I would say the answer is probably no. The current product will not have a diversified global bucket of REITs. But there are certainly attractive opportunities in REITs outside of Singapore as well. Although I think the yields here in Singapore are quite attractive, and so it's certainly again something to consider for clients that are interested in a global REIT portfolio. As we consider how our product lineup evolves over time.
Great. So shall we move on to the next section? I think that's.
Sure. So in the interest of time, and I'm sure a lot of people who are watching tonight are pretty familiar with Saif, so I won't spend a lot of time on each of these slides. But just to recap, for those of you who are still getting to know us, so this is a slide that just covers the history of the company, As I'm sure you know, we're a very young company, but growing very, very fast. We've launched, our 4 key products in the last year. The most recent one was our core suite in March. Prior to that was the Cash Plus product, which we launched in January. And those both followed our Series A funding round, which happened back in September. So we're very excited about how fast we've been growing, and thank our customers for their support and continued support, and we're really excited for what's next for the company. We have a really strong and growing team with people from a broad range of large financial institutions as well as technology companies. And then you can see on the right-hand side, our core leadership team led by Dhruv Arora, our CEO and founder. The important stuff here, we hold a retail fund management CMS license from the MAS. Your assets with Cypher held with the largest institutions in Singapore and the world. DBS is our trust account for your portfolio assets. We trade through Saxo Capital Markets, and Citi and HSBC are our custodians. Just a quick recap of what we currently offer on our platform. And as I said, we're always considering new options to expand our product offering. Right now, moving from left to right on this slide, from the lowest risk to, I guess, the highest risk strategy. First is our Cash Plus, which is a high return cash portfolio, currently targets a projected return of 1.5%. So really seen as an equivalent to or an alternative to a deposit product, has no lockups, no limits, no tiers, and we don't charge any fee on that product as well. Moving across to REIT Plus, which is our Singapore REIT product, offers a high dividend yield of 4.5% for those looking for passive income, as well as growth from the underlying asset value appreciation from the properties held by these REITs. We do offer that in 2 formats. One is 100% REITs, and one is REITs with risk management, where we can move the allocation between REITs as well as Singapore bonds, as our model assesses the risk of those 2 asset classes. Moving to the right to our core suite. So as I mentioned, that was launched a couple of months ago. This is really a suite of 3 different products that are suited to clients' individual risk buckets. So we have a defensive portfolio, a balanced portfolio, and a growth portfolio. And they are all allocated across global equities, bonds, and gold, with obviously the growth portfolio having a higher allocation towards the higher risk asset classes like equities, and defensive is the opposite. And as has been mentioned already, we do seek to make adjustments to the global benchmark allocations where we think they don't necessarily line up with what our models say, where our models say the opportunities lie. And right now, that means we do have a higher allocation towards China and China tech within those portfolios. And then finally, on the right-hand side, our Equity 100 portfolio, that's our pure equity, high growth oriented portfolio. We have a smart beta strategy that underlines that, where we look at optimizing the factors to outperform our index over the long term by investing in equities globally. So that's what's on our platform. I wanted to give an update, since this is a market update, wanted to give an update on performance of our portfolios. So we're showing here each of our portfolios on the left-hand side, and then their respective benchmarks, to the extent they have benchmarks. So you can see that over the long term, we have performed at the very least in line, and in most cases in excess of our benchmark. So if you look in the 5-year numbers, which are obviously using back tests because we haven't been around for 5 years, but you can see that most portfolios have outperformed this year, particularly for Equity 100 as well as some of the core portfolios. There has been a slight underperformance. Our portfolio for Equity 100 does have, a bit of a growth orientation. And as we mentioned earlier, there has been a move, slight broadening of the equity rally that has included more value sectors. And we have recently made an adjustment to increase our allocation to value in equity 100, but that has led to a slight underperformance year to date. Though we're quite confident on a go forward basis that we can meet and exceed the benchmarks. So that's our returns. One thing we really wanted to point out was, we get a lot of questions around, well, why do you use ETFs versus mutual funds, or some people call them unit trusts, for our underlying. Some people ask us about the advantages and disadvantages of using US listed ETFs, for example. And I think the key answer we give is that, fees make a huge impact on returns. And I'd like to, highlight, for example, on this slide, the last row, which is a comparison of, basically two portfolios that provide exposure to the S&P 500 in the US. So for the fund, which is on the left, we've chosen to highlight the Infinity US 500 stock index fund, which is the US dollar equivalent. And that fund has a total expense ratio, or TER, of 0.67%. And so has delivered a 10-year annualized return of about 10.5%. And if you compare that to the comparative ETF, so on the right-hand side, we're using the iShares Core S&P 500 UCITS ETF. The return is 13.71%. Now, both of these are passive index tracking funds. There's no, active management at all. Really, the difference comes to the implementation and the fees. And so, the mutual fund has a fee of 0.67%. That doesn't even include a lot of the additional costs, like brokerage costs, that are incurred by the fund to execute that strategy. And that compares to the UCITS ETF, which has a TER of just 0.07%. And so you can see over the long term, those different fees do really have an impact on the underlying returns for those funds. The other point we'd like to just highlight quickly is around the withholding tax. So we get a lot of questions. Well, by investing in US funds, are you not exposing investors to withholding tax? Yes, but withholding tax applies to dividends only, not to capital gains. So for example, QQQ, which is the ETF that essentially tracks the NASDAQ, the dividend is 0.46%. And if you compare that to the withholding tax is 0.3%. So it's a pretty minimal impact on returns. And if you compare that to the UCITS equivalent ETF, where the withholding tax is 15%, often the fees are higher. And so the tax benefits of reducing withholding tax by moving to a UCITS ETF are offset by high management fees. Now, that's not always the case. And in some cases, we are happy to use, UCITS ETFs, and we do use UCITS ETFs where it makes sense for clients. But, we believe just simplistically saying, well, the US, withholding tax issue is the only thing that should drive which vehicle you use to gain exposure. We think that's simplistic. We like to look at all different layers and the all-in cost for our clients of using different vehicles. I'll probably skip over this slide, but it basically has a representation of how our clients can use different size portfolios for different buckets in their overall portfolio. And then just lastly, or getting towards the end, just mentioning we do have a fantastic app. So you can access our services through the app. You can access them through the web. On pricing, we have pricing tiers. So depending on the level of assets you have with us, We don't have any minimums at all. So if you have less than 20,000 with us, you're in the blue tier with still very low and competitive management fees of 0.65%. And then those fees do reduce as the level of assets you have with us increases. We do have a fairly new offering led by Ritesh and team, which is called Scythe Private Wealth, with an even lower fee level of 0.35% for clients who have 500,000 and above. That gives you access to a dedicated wealth advisor and a whole host of other advantages. So if you would like to find out more about that, then please send us a message or reach out, and we're happy to share information on that. So just to summarize what we offer to clients, no trading fees, no entry, no exit charges, no minimum balances whatsoever. You can get your money out from Scythe at any point back to your bank account. We rebalance your portfolios automatically at no cost to you. And we spend a lot of time finding the best, lowest cost ways to implement portfolios through ETFs. And we think this is a very favorable offering relative to DIY. Obviously, when you open a brokerage account and try and do this yourself, there's a lot of additional complexity, risk management. There's no order rebalancing, no optimizing. There are fees both in and out to transact. And for clients that use managed strategies, there are quite high management fees as well. So just before we wrap up, just to highlight a couple of events that we have coming up. On the 20th of May, we have, in partnership with State Street, which is one of our partners, we have Rebecca Chesworth, who's a senior equity strategist, talking about the power of sector investing through ETFs. So we're really excited to partner with State Street and have Rebecca join us for that session. And then the following week, on the 27th of May, we have our head of distribution, Sebastian, to give us a deep dive on all the products across Scythe's platform. This is going to be a great session for clients who are newer to Scythe and really want a deep dive on everything that we offer on our platform. So with that, I'll hand it back to Melvin to see if there's any additional questions from those who are dialed in.
Okay, so I think this question is weighing in on everybody's mind. So tech is starting to see a major sell-off this week. Is this a sign of a start of a market crash? Ritesh or Nick?
Look, we've covered that. I think the reality is, while there is obviously a correction happening in some, particularly the meme stocks, some of the stocks that had exceptionally high returns in 2020 and the first month of this year. We see this more as a return to normal and a broadening of the equity rally. As Ritesh has pointed out, there's still, while valuations are relatively stretched overall, interest rates remain very low. There's still a huge amount of fiscal stimulus going through the economy. We don't expect that what we're seeing in select names within the tech space is going to flow through to the broader market in terms of a massive correction. Now, obviously, the market has been fairly one-directional for a while, and there is going to be volatility. I mean, equities are a volatile asset class, and so will we potentially see a 5 to 10% a healthy correction in the market? Potentially, yes, and we would welcome that. That's a sign of a healthy market. If the market just keeps going one direction, then that's what gets me worried, actually. No one has a crystal ball, but we think that all indicators point towards a continuation of fairly buoyant conditions in the market as the economy recovers.
Right. I think and on top of that, I think the quality of the names that you hold is actually equally important. So, as Nick was pointing out, if you just have these meme stocks or very, very high growth oriented, companies which actually might not even have any positive earnings to them. They're just having very, very high, say, revenue growth per se. Those are areas where we were seeing some froth. So as Nick mentioned, it is more of a rationalization that is happening, and it's a fairly healthy correction. If you look at the big tech Q1 earnings, like, if you look at Apple, Alphabet, Amazon, Facebook, Microsoft, all have reported earnings beat coming into this quarter. So, I don't think, fundamentally there is a problem with quality tech names per se. But as Nick was mentioning, like, it's a more broadening out of the rally that we are observing. And what that means is there might be some rotation out of tech and some rotation into value sectors. But if you're a long-term investor, I don't think you should be too worried about it. And overall, if you have a diversified portfolio, I think that should be easy enough for you to navigate.
Great. So thank you both for the answer. Another one will be back to the REITs topic. So we intentionally excluded any foreign currency denominated REITs. Is there any chance of actually adding them back in to have like a closer replicated variant of the leaders index actually?
Look, we'll have to get back to you on that one. I think, there's various factors that go into our model of replication. At this stage we're confident we have the formula right, but we don't have a specific plan to change the allocation at this point in time.
Right, and I guess the fact is that this particular strategy is meant to serve a specific purpose. It is meant to give you access to the Singapore REIT market as well as more regional REIT market, and have minimal impact in terms of FX and other things, especially if you're using it as an income strategy. But at the same time, we do acknowledge that people are looking for broader REIT exposures and all, and just wait a little bit and give us a chance to enhance our offerings. If we cannot sort of change what is this portfolio, look out for newer offerings that we might come across.
Great, thank you very much again. Another one, I think this one will be good for you, Ritesh. So will there be a facility to use SRS funds ahead?
Yes, absolutely. We are have been working really hard to make SRS available for our investors as well. Some of the stuff to be able to offer SRS investments is actually beyond our control. So there have been some hiccups on those fronts. But having said that, we are actively looking at other ways and means for us to include SRS investments for our investors. So, again, please bear with us and have some more patience. Hopefully, by the end of the year, we will have a fairly clear idea how we want to implement our SRS strategy.
Okay, so I think that's about all the questions for this evening. Any closing statements from you both?
I guess for me, I think it is just about again, the markets are slowly, looking like there are some corrections in the market. And, if you had invested into some, single names and all, this is also a reminder why it is important to have a diversified portfolio. And I think this is where we at SIFE specialize in. So make sure, number one, if you're looking to build long-term wealth, you build a solid foundation to your investments. And that means, have a diversified portfolio that can sort of sustain through these, volatile periods in a much more smoother manner. And that will really help you position to reach your goal in a much more stable aspect. And again, as I mentioned earlier, it is the journey to your goal is equally important to, rather than just reaching the end goal per se. And remaining invested is a key element to that. So, just repeat it again, time in the market is much more important than timing the market. So stay invested and use these as opportunities for you to, look back at your risk profile, your risk appetite, if you need to diversify, or even use it as an opportunity to, if you have spare cash sitting idle, these could be opportunities for you to deploy.
Yeah, I'd just like to thank thank clients for their support. We really appreciate it. We work very, very hard to deliver great products and strong returns for you. So thank you very much, and please reach out to any one of our team if we can help answer any more questions or help you with anything else. We have a really great team of advisors who work with Ritesh. So please do use us for advice. If something in the market is concerning you, reach out. We're happy to help.
Great. So I believe that's the end of the session for today. Have a great evening ahead, everybody, and thank you all for using Site. Cheers.
Thank you.
Thanks, everyone. Have a good night. See ya.